Welcome to Talk Tickers, your shortcut for getting up to speed on key earnings calls.
And today, we're diving into the latest results from Pool Corporation.
Yeah, our goal here is pretty straightforward. Pull out the essential figures, the key insights you need, save you some time,
Exactly. Let's get straight into the numbers for Q1.
Okay, what's the top line?
Well, overall sales, they were actually down 4% compared to last year. Or 2% if you look at it on a same selling day basis. Revenue came in at $1.1 billion.
$1.1 billion. And earnings.
Earnings per share, EPS, landed at $1.42. Now, it's worth noting that includes a 10-cent benefit from an ASU tax update.
Okay, a little boost there. And margin.
Gross margins stood at 29.2% for the quarter.
Right. So a dip in sales overall, but I imagine there's more to the story beneath that headline figure.
Oh, absolutely. It's definitely a mixed bag. For instance, chemical sales were actually up 1%.
Okay, that's interesting. Maintenance side holding up.
Exactly. And get this, their private label chemicals saw double-digit growth. Huge jump there.
Wow, so people are definitely still maintaining their pools. What about construction materials?
Building material sales were down 5%, but that's actually an improvement from the decline they saw last quarter.
So maybe stabilizing a bit.
Could be, yeah. A hint of stabilization, perhaps? Equipment sales, though, were down 4%.
Okay. Any particular bright spots in their different business areas?
Yeah, the commercial business segment. That was up a solid 7% in sales.
7%. That's pretty significant given the overall trend.
It really is. Suggests they're making good inroads there, leveraging acquisitions maybe.
And their online platform, Pool 360.
Still growing. Orders processed through Pool 360 made up 13% of total sales.
Up from what, last year?
Up from 11% in Q1 last year. So, yeah, continued adoption of digital.
Okay, so a complex picture in Q1. Some strengths, some weaknesses. How are they feeling about the rest of the year then? Did they update guidance?
Interestingly, no. Despite the mixed Q1, they've maintained their full year 2025 EPS guidance. Still targeting $11 to $11.60.
And that includes the tax benefit.
Correct. That $11.10 to $11.60 range includes the 10-cent ASU tax benefit from Q1.
Did they see any improvement later in the quarter?
They did mention that March sales showed a positive trend. Actually grew by 2% on a same-day basis compared to March last year.
Okay. A little bit of positive momentum maybe towards the end, and expanding their footprint too.
Yep, opened 2 new wholesale distribution locations. That brings our total up to nearly 450 centers now.
All right, let's dig a bit deeper then. What's causing this overall softness? It sounds like the economy is a big piece of it.
That's definitely the main theme. Management pointed squarely at continued softness in discretionary spending.
Makes sense for big ticket items like pools.
Exactly, and the data backs it up. New pool construction permits were still lower year over year in Q1.
Any specific regions feeling it more?
Texas was mentioned as being particularly weak on the new construction front.
Right, and management's explanation.
They talked about macroeconomic uncertainty, high interest rates causing consumers to adopt a sort of wait-and-see attitude for those big discretionary buys.
So projects are taking longer to get signed off.
Yeah, a longer time to contract for new pools, although they did note that the higher-end pool buyers seem less sensitive to the interest rate hikes.
Okay, so a bit of a split there. Now, how did this play into their gross margins? You said 29.2%. How does that compare, really?
Well, it's interesting. The comparison point, Q1 2024, was 30.2%.
But there was something unusual last year.
Exactly. Last year's Q1 had a one-time benefit from an import tax situation. If you strip that out, the Q1 2024 margin was actually closer to 29.1%.
Ah, okay. Right. So on an adjusted basis, it's actually a slight improvement year over year.
Correct, a slight improvement. They credit that to pricing optimization and supply chain initiative they've been working on.
But it wasn't all smooth sailing on margins.
No, they did acknowledge that competitive pricing pressures picked up in Q1, and that squeezed margins a bit more than they'd initially planned for.
Understandable in this environment. Let's circle back to the segments. That chemical strength, especially private label, seems really key.
It really does. It highlights that recurring revenue stream from maintenance. People have pools. They have to maintain them.
Right. It's not really optional spending once you have the pool.
Precisely. And that double-digit growth in their own brands suggests they're capturing more of that essential spending directly.
And the building materials slowdown easing, maybe a bottoming process.
It's possible. Too early to call it a recovery, but seeing the rate of decline lessen is certainly a positive sign.
And commercial growing strong, Pool 360 adoption up, Those look like solid strategic wins.
Yeah, the commercial side suggests they're executing well, maybe integrating acquisitions effectively, and Pool 360 becoming more embedded is crucial for long-term efficiency and customer loyalty.
Now tariffs, always a concern. How are they impacting Pool Corp?
Management downplayed the direct impact. Said direct import exposure is actually pretty small, less than 1% of revenue.
So it's more indirect, through suppliers.
Exactly. The main hit is in the equipment category, where the manufacturers they buy from are facing higher costs because of tariffs.
And are those costs being passed on?
Oh yeah. Major equipment vendors have announced and already put through price increases, like 3 to 4% in April.
Any more coming?
Yep. Pentair apparently announced another 4% increase for June.
So Pool Corp has to raise its prices too.
They have been, and they said they'll continue to. They expect those increases to just pass right through the channel.
And what does that mean for their overall pricing picture for the year?
They estimate that these vendor price hikes will give them about a 2% pricing benefit for the full year.
Interesting. So they're absorbing the hit from suppliers, but passing it on, effectively boosting their own top line through pricing.
Seems to be the strategy, yes.
Yeah,
Which feeds into why they're holding that full year guidance steady.
right, despite the soft Q1 and the macro challenges.
Yeah, they're banking on their strategic initiatives, helping them outperform the broader market as things hopefully normalize. That 2% pricing lift certainly helps support the outlook too.
Even with new construction permits still looking weak.
Even with that, they seem encouraged by the sales trends improving in March, and they hinted into April as well.
Okay, let's talk geography. You mentioned Texas was weak. How did other areas fare?
It was definitely varied. Arizona actually saw a 2% sales increase.
Oh, positive territory.
Yeah. California was flat. Florida was down just 1%, but then Texas, like we said, down 11%.
Quite the drop. Any reasons given besides the permits?
They mentioned challenging weather in January and February, impacting Texas and also parts of Florida.
Weather. Always a factor. What about internationally? Europe.
Europe saw a 4% decline in local currency, which is about 6% in US dollars. Again, blaming macro uncertainties over there.
Any bright spots in Europe?
They did call out Spain and Portugal as showing positive trends, which is interesting.
And the Horizon business.
Horizon net sales declined 4%. They said that was mainly due to commodity price deflation, especially in PVC pipe.
Okay. And operationally, besides the 2 new wholesale spots?
They also highlighted adding their first Pinchy Penny franchise location in Arizona.
Pinch a penny. That's more focused on the DIY homeowner, right?
Exactly.
Yep.
So expanding their reach into that do-it-yourself market.
Yeah.
And they continue to focus on supply chain efficiencies with their domestic central shipping hubs.
Gotcha. And just quickly, their financial health balance sheet.
Still strong. They mentioned their leverage ratio is at the lower end of their target range.
So flexibility there, using it for buybacks.
Yep. Bought back $56 million worth of shares in Q1. And they plan to ask for an increase in their repurchase authorization as well.
Makes sense. Standard capital allocation priorities.
Pretty much. Investing back in the business, M&A, dividends, paying down debt, and those share repurchases. Covered all the bases.
All right. Now for our favorite segment. This is not financial advice, of course, but based on all this. Let's toss around an outrageous but plausible trade idea. What jumps out?
Okay, here's one thought. We keep seeing this strength in maintenance, right? Especially the private label chemicals, that double-digit growth. And new construction is slow.
So people are fixing up, not building new.
Exactly. So what if you looked at companies really doubling down on the DIY pool maintenance side? Maybe those with strong e-commerce, perhaps even subscription models for chemicals and supplies.
Betting on the homeowner taking charge of maintenance to save money, maybe?
Yeah, capitalizing on that trend. It leans into the recurring revenue aspect, the chemical strength we saw, even the pinch a penny expansion into DIY. Could be an interesting niche play, even if the broader economy is wobbly.
I like that angle. Okay, my turn. How about this? We know equipment prices are going up due to tariffs, and Pool Corp expects to pass those through. They estimate a 2% pricing benefit for the year from it. So maybe a paired trade. Go long Pool Corporation, betting they manage this pass-through effectively, maybe even enhance their revenue because of it.
Okay, long Pool Corp and short.
And maybe short a basket of, say, general home improvement retailers or companies selling other big-ticket outdoor discretionary items, things less essential than replacing a broken pool pump.
So you're playing the relative resilience. betting that people have to replace core pool equipment, even with price hikes, more so than maybe buying a fancy new patio set.
Exactly. It leverages the idea that Pool Corps' pass-through will stick better than price increases on more optional home or yard upgrades during uncertain times.
Definitely outrageous, but plausible. Some interesting food for thought there.
So that wraps up our deep dive into Pool Corporation's latest earnings call.
We've hit the key results, the headwinds, the strategies, the outlook.
Hopefully that gives you a much clearer and more efficient picture of what's going on with them.
We always hope these discussions spark your own thinking. What stood out most to you from this call? What questions pop into your head?
Yeah, what does it make you wonder about the market or your own approach? Let us know. Join us next time on Talk Tickers for another earnings breakdown.